This slide is a continuation of our presentation of September the 25th, which involved cash and cash receivable, or cash and cash equivalents, and also inventory. And we're going to continue with our inventory discussion or presentation, and it will be including how we account for consigned inventory. And inventory valuation regarded how do we value inventory under a periodic weighted average basis, perpetual moving average basis. We're going to do at least one slide on LIFO versus FIFO inventory characteristics. Also, we're going to do LIFO under perpetual inventory, dollar value LIFO, and inventory as lower of cost or market. So let's go on now and take a look at accounting for consigned inventory. Now, under consignment accounting, there are two types of parties, at least two types, and that is there is a consignor. In other words, the entity that actually owns the product, and there is a consignee, and that is where the product is basically being, if you will, placed on loan to in order to sell it. So that's the consignee. Now, let's go over the easiest way to look at the accounting is to take a look at the basic journal entries in terms of consignor and consignee on consignment accounting. Okay, inventory that is transferred to the consignee is still inventory to the consignor. In other words, it's on the consignor's books, even though the consignor has basically shipped that inventory to this entity called the consignee. So when we consign the inventory, typically what we will do is we will make sure, or we will ensure from a financial reporting point of view, that we take that amount out of our normal inventory account, and then we're going to move it into the special account called consigned inventory. So this represents a value of all inventory that is on consignment. So the next step then is getting the consigned inventory to the consignee. And we include in the cost of that inventory then the cost of transporting the consigned inventory or other costs. Those are typically borne by the consignor, and those costs go into the value of consignment inventory. In this case, I assume that we paid cash for the transportation or other costs, so it would be a credit to cash and a debit to consignment inventory. Now you'll notice during this time, these two journal entries, no entry on the financial records are made as there's no transfer of asset. The consignee basically is acting as an agent on behalf of the consignor in terms of selling the merchandise. Now we have inventory that is sold by the consignee. So in this case, we record a sale on the consignee side, and we're going to debit in this case. We're going to say debit accounts receivable, could be cash or some other form of receivable for the sale of the consigned inventory of the customer. We're going to have two credit entries. One entry will be for accounts payable, and that's going to recognize the liability that the consignee has to the consignor for the value of the merchandise now that they owe for that sale from the basically to the consignor. Also, as part of that sale, they earn sales commission revenue. So the company recognizes that portion of the sale that is going to represent basically a commission to the consignee. So we credit sales commission revenue, that is to recognize the commission earned on the consignment sale. We take a look now at the consignor. Oh, by the way, the other thing to note here is, you note when I sell this item and I debit my accounts receivable, I debit it for the full amount of the sale. But I split the sale up into those two parts, and one is the liability to the consignor for the consigned cost of the merchandise, and then the remainder amount is sales commission revenue. So we don't record the entire amount as a sale. We record the sales commission portion as revenue. Okay, we now look at when the inventory has basically been sold on the consignor standpoint. The consignor is going to debit accounts receivable, and that's to recognize the receivable due for the consigned goods that the consignee sold. Also then, they're going to recognize a credit to the sales account to recognize the amount of sales that the consignee owes them the amount of the sale less the commission, and the consignor recognizes the total sale. Also, at the same token, but at the same time, because the consignor owned the inventory, it's going to remove that inventory from consignment inventory and then charge that cost to the cost of goods sold. So that's consignment inventory. Okay, let's try a couple of questions on consignment inventory. Question number 9, shipping costs that are incurred by a consignor on the transfer of goods to a consignee should be considered as, and we have 4 choices. And go ahead, stop the video, consider the choices, make your choice, and then when you are ready, restart your video for the answer slide. Okay, the answer to question 9. Shipping costs that are incurred by a consignor on the transfer of goods to a consignee should be considered as, and in this case, it would be as D, inventory cost to the consignor. Remember from our previous slides, cost of transporting consigned inventory or other associated costs are borne, that should be BOR and not borne by the consignor. And remember when I illustrated that, it was a debit to the consigned inventory and credit to cash on the consignor's behalf. Let's try question number 11. The following items were included in Cigna's inventory account at year end. That includes merchandise that's out on consignment to a consignee, and Insignia's recorded it at its full sales price, including, that means it's a cost plus a profit in the inventory. So that includes a 50% margin on the selling price of $60,000. So that's what it's recorded at as on Insignia's books. Number 2, goods purchased in transit, they're shipped, FOB, shipping point, $20,000. Those are on the company's books. Third, goods held on consignment by Insignia, $40,000. So the question is, by what amount should Insignia's inventory balance at year end be reduced? So we know it's going to have to be reduced by something, so we have 4 choices. Go ahead, review those choices, make your calculations as you stop your video, and when you're ready, restart your video. Okay, the answer to number 10 is, again, by what amount should Insignia's inventory balance at year end be reduced? So we're going to take a look at all 3 of these items. We know that we've recorded our inventory that is out on consignment to a consignee, and what we've recorded it at is at its selling price. But of course, inventory should be recorded at cost. So the reduction in this case would be $30,000 because that represents our inventory that is out on consignment. And that would be the profit or the margin that for whatever reason we recorded in the inventory account. And the calculation is that $60,000 amount times a 50% margin. So that represents $30,000 represents the profit on that inventory. So we're going to remove that profit out of the inventory because it really shouldn't be recorded. Number two then is we have goods purchased in transit and shipped, FOB shipping point, and the amount is $20,000. Now, remember, according to the shipping terms, FOB shipping point means Insignia owns the property or owns the goods as soon as those goods are being shipped by the common carrier. So in effect, if that's the case, the goods are in transit, so they are already being basically transported by the common carrier. So in that case, Insignia actually owns that property even though they haven't received it yet. So in this case, there'd be no reason to reduce the amount because Insignia does own that property. The third item is goods held on consignment by Insignia. So in the case of this $40,000, in effect, Insignia is acting as the agent for the consignor. So Insignia doesn't actually own that consigned inventory. So that consigned inventory would also be reduced from the inventory balance. So our total reduction would be $70,000. Let's go on and now examine valuing inventory using the periodic weighted average method or weighted average method. It's actually a very simple calculation. We start out with the dollar value of our beginning inventory. So this scribble here looks like a dollar value. So the dollar value of beginning inventory plus the dollar value of purchases. We divide that then, so we end up with the total value of beginning inventory plus our purchases during the year. We divide that dollar amount by the number of units in beginning inventory plus the units purchased during the year. This calculation then results in what we call the weighted average cost per unit. And what's going to happen is we're going to use that weighted average cost when we take an inventory at the end of the year to value our inventory at the ending inventory using that weighted average cost. So this is best illustrated through an example. Here we have a company that started out with 100 units in beginning inventory. And the value of those units was $2,000. And where did we get that number from? We got that from the previous year's ending inventory. That becomes our beginning inventory. So during the year, the company purchased 50 units of additional inventory. Those are units. And the company spent $1,060 for that additional 50 units of inventory. Also during the year, we were able to sell 110 units of inventory. So what is the cost of goods sold for the year? So again, this is we're going to go through the illustration, and before we go on, just notice this. We use the classic cost of goods sold formula for inventory. Beginning inventory plus our purchases, or inputs if you will, minus in this case our ending inventory, which basically equals our cost of goods sold. So that's the classic inventory formula. Typically it's beginning inventory plus our purchases minus our outputs, which would be cost of goods sold, equals our ending inventory. We just flipped the algebra all around a little. So again, beginning inventory, we're told that it's $2,000, and that was from our prior year period inventory, our ending inventory. Now, during the year, we can compute the weighted average cost per unit, and that's very simple. We take the $2,000 beginning inventory plus the $1,060 that we had received, or that we spent on those additional 50 units. We divide that total dollar amount then by our 100 units in beginning inventory plus the 50 units we purchased during the year. So when we do that calculation, it comes out to $20.40 a unit. So every inventory item is worth $20.40. Now, let's go on back here with beginning inventory. We now go again to how much inventory did we purchase, and we know that total amount was $1,060, and we know that because that's given to us in the problem. Okay, now we have to, in order to get to cost of goods sold, we have to calculate the ending inventory, because remember, our beginning inventory plus our purchases total to the total merchandise that we have available to sell. So if we basically take an inventory and subtract out the ending inventory, that must be what we sold. So our ending inventory is $816, and here's how we get to it. Okay, we know we're going to have at the end of the year, there's going to be 40 units on hand. How did we come up with that? We had 100 units in beginning inventory, plus we purchased another 50 units during the year. So there's our 150 units, the beginning inventory plus our purchases. We're also told that 110 units were sold during the year. So we take 150 units minus 110 units, and that's how we get our 40 units on hand. So we know we have 40 units in our ending inventory. Now we take those 40 units times our weighted average amount of $20.40. That's a value per unit times 40 units. So the average cost, basically the weighted average cost per unit, is $816. So the value of our ending inventory is $816. So again, now we have our beginning inventory plus our purchases of $1,060. That means the total cost of goods that we had purchased for the inventory was $3,060 during the year. From that, then, we had $816 left over, which means the amount that we must have sold was $2,244. And that's the illustration of how we calculate periodic ending inventory on a weighted average basis. Now let's try a multiple choice question regarding the valuation of inventory and cost of goods sold utilizing the periodic weighted average method for inventory. In this case, ABC Company maintains a periodic inventory system, and what that means is that cost of goods sold is normally computed when the company takes an inventory using the classic cost of goods sold formula, which is beginning inventory plus purchases minus the ending inventory, and that should equal your cost of goods sold. So we are told here that the company uses a weighted average costing method. So we're told that information. Okay, the company had a beginning inventory value in the year 2 of 2,000 units with a value of $18,000. And again, that number came from the previous year's 1 ending inventory. Now, during the year, the company purchased 5,200 units at a cost of $72,000. Now, at the end of year 2, the company conducted a physical inventory, and based upon that physical inventory, the company verified that 2,600 units were remaining on hand in the inventory. So the question is, what is the company's cost of goods sold for year 2, go ahead, stop your video, do your computations, and make your selection. When you're ready, go ahead and restart the video and review the answer slide. Okay, the answer to the question, what is ABC Company's cost of goods sold for year number 2? And the answer in this case is C, $57,000. Now let's take a look at how we calculated that. Okay, we know we started out with a beginning inventory of $18,000 in terms of value. During the year, we purchased $72,000 worth of additional inventory items. Now what we're going to do is we're going to take the total cost of goods available for sale, the total dollar amount, and we're going to divide it by the total number of units that we had in beginning inventory and the number of units we purchased during the year. So it's going to be $90,000 divided by, if we work out the equation here, $90,000 divided by 7,200 units. That means the average cost of our inventory is $12.50 per unit. So now in order to get the cost of goods sold, we're going to have to first compute our ending inventory, then subtract that from the total cost of goods available for sale. So in order to value our ending inventory, we take the amount of inventory that was left over at the end of the year, which is 2,600 units, and we multiply that times the average inventory cost per unit, which we just computed above at $12.50. That means the value of our ending inventory is $32,500, and we place that in our ending inventory within our computation schedule. So we take the total cost of goods that were available for sale during the year minus our ending inventory, and that should compute to the cost of goods that must have been sold during the year. And that's the answer to question number 11. Now let's take a look at another way of costing inventory, and this is different because instead of being on a periodic basis, we're talking about maintaining perpetual inventory records. That means every time there's an inventory transaction, we update the detailed inventory record associated with that inventory. So in effect, what we're saying is the inventory cost per unit is computed after each transaction, and we're going to do this valuing inventory on what we call moving average basis. So here we have a representation of what may be an inventory card. It could be kept manually, or pretty much nowadays it's probably being kept on a computer. And what we're going to see here is we have our date, the type of transaction, the number of units involved, the cost of the transaction, units on hand, inventory balances, and computed cost per unit. Now let's take a look at the beginning inventory information here. So we're starting off with beginning, and what we have is we find we have 100 units on hand. In terms of our inventory dollar balance, if we do the computation, at this point in time, we're assuming that the inventory had a cost per unit of $20 per unit. Where did that come from? From what I just made up. And in theory, that would be from a previous month's inventory card. So it's 100 units on hand times $20 cost per unit. That means our inventory balance overall, based upon that 100 units, would be 2,000 units. And if we compute the cost per unit, 2,000 divided by 100 units, that means our cost per unit is $20 per unit. Okay, now let's go on to the first transaction during the month, so date number 1. We're buying 20 more units of inventory, and we're paying $32 a unit. So what is the cost of that transaction? And in this case, the cost of the transaction is $32 a unit times our 20 units that we just bought. So the cost of the transaction is $640. So what happens now is that we're going to basically record the total cost of that increase in inventory, in debit inventory, for $640, and credit, in this case I'm crediting accounts payable or any other type of liability, or let's say cash account. It really doesn't matter. So now the units that I have on hand equal my original units of 100 plus the additional 20 units that I purchased from this transaction. So my units on hand now are 120 units. Now, if I compute my inventory balance, if I was tracking my inventory account, it would be equal to the original $2,000 from my beginning balance plus the $640 that I've added as a result of the purchase of the transaction. So my inventory balance within my general ledger and this inventory card would show an amount of $2,640. Now I want to compute what is the cost per unit in my inventory, and you'll notice I call this a moving average. So I'm going to take the cost from my previous transactions, which is basically my $2,000. I'm going to add the $640 addition, so the total comes up to $2,640. Now I'm going to divide it by the number of units on hand, which is 120. So now my cost per unit is now $22 per unit. It is no longer $20 per unit. The cost now is $22 per unit based upon a perpetual moving average basis. Now we're moving on to the second transaction. Okay, I call it date number 2, but our second transaction, in this case, we're selling inventory, and we sold 70 units of inventory. Now the question is we're keeping perpetual records, so now we're going to calculate our cost of goods sold for this sales transaction. So in this case, what we're going to do is we're going to take basically the sales number of units we sold, 70 units. Now we're going to take the cost per unit, which we know to be $22 per unit. So it's 70 units times $22 per unit. And the cost of goods sold and the amount that we're removing from inventory is $1,540. So we debit cost of goods sold for $1,540 for those 70 units, and we credit inventory for $1,540. Now we take a look at the units that we now have remaining on hand, and I'll do the computation down here, but we started out with 120 units previously. From here, we sold those 70 units. So in the end, we have 50 units remaining. That happens to be the units on hand in our ending inventory. Now, if I do the computation on my inventory balance, it's going to be the $2,640. That came from my inventory balance in my previous transaction. I'm going to subtract out the $1,540, and the inventory balance now in my general ledger account will be $1,100. So I take the $1,100, I divide it by the 50 units that are remaining in inventory, and my cost per unit on a moving average basis is still $22. Now let's take a look at our next transaction, and let's assume that we're purchasing 30 more units and we're only paying $14 a unit in this particular case. So if we value this purchase, it's going to be 30 units times that $14 purchase price. So the cost of the transaction is $420. So now we can add that amount to inventory. So we're going to debit inventory for $420 and credit cash or accounts payable, whatever account, for $420. In terms of our units on hand, it's 50 units from our previous units. We add to that the additional 30 units that we just purchased. So the number of units on hand in our perpetual inventory now are equal to 80 units. Now again, if we take a look at the effect of the balance in our general ledger for this particular inventory item, we take the $1,100 balance, which was from our previous transaction. To that, we add the $420, and that means our total inventory balance will now be equal to $1,520. Now at this point then, we take the $1,520 and we're going to divide it by the 80 units on hand, which means now our moving average cost per unit now equals $19 per unit. Now let's look at the last transaction. And in this case, we're selling 40 units. And since we're selling 40 units, we take the cost, or the value of this transaction is going to be 40 units times our $19 cost per unit, which means 40 units times $19 equals $760. So that's a value that we're going to be removing out of inventory and placing in cost of goods sold. And you can see the entry here: credit inventory $760, debit cost of goods sold $760. Now we take a look at our units on hand. We started out with 80 units on hand. From that then, we know we sold 40 units. And based upon that, we have 40 units remaining in inventory. So now we take the $1,520 from our previous balance, we move it down here, and now we subtract the $760 from our inventory balance. So it's $1,520 minus $760. That means we have a balance now of $760 left over. And we divide that $760 by the 40 units on hand, and we come up again to $19 per unit in inventory. So in effect, every time we have a transaction in inventory, we recalculate the moving average, and it becomes our basis N for our next transaction. So this is a perpetual moving average calculation. This next slide is a multiple choice question, and it's based upon a perpetual inventory system using a moving average basis. And it's written: the following information pertains to the inventory noted on a company's, again, key information, perpetual inventory system. That means we're basically recomputing balances, dollar balances, and inventory balances after every transaction. Now, under the moving average method, what is the amount of inventory basically at the end of the month? And we're given in effect, the inventory card here with the inventory transactions. Again, perform your own computations based upon this card here, and also obviously stop your video, and after you've done your computation and selected what you consider to be the correct answer, go ahead and restart the video and review the answer slide. sorry, let's go ahead and take a look at the inventory card, or the amount, the calculations we should do after the inventory card. We have our beginning inventory, and we know that's 1,000 units, and the unit cost is $1 a piece. So in this case, the total number of units we have starting off with, the units on hand of 1,000, is the accumulated number of units to date. The accumulated cost is simply the average unit cost times the accumulated, the average cost per unit times the accumulated number of units. So the accumulated cost is $1,000. Okay, then we move on to purchases in day 5. So we're purchasing 600 units and we're paying $300 per unit, and that means there's going to be a total cost of $1,800. So here we show the purchase, 600 units at $3 a unit. So the total transaction cost for this transaction is $1,800. And the number of accumulated units would be equal to our previous 1,000 plus the additional 600 units. So the accumulated number of units to date is 1,600 units. So if we walked out and counted our inventory, we'd expect to see 1,600 units in our inventory. Now the accumulated cost is equal to our previous cost of $1,000 plus the amount of the transaction cost that we have just added to the inventory record. So it'll be 1,000 plus 1,800. That means the accumulated cost, and that would be the cost in our general ledger, or the value in our general ledger would be 2,800. Now to come up with the average cost per unit, we take the $2,800 in accumulated cost, and we're going to divide it by the accumulated number of units, the total number of units on hand, and that's going to come out to $1.75 per unit. So that's our average cost per unit at this point. Now we're going to sell the next item. Now we're going to sell 900 units. So we sell the 900 units. And in this case then, when we sell the 900 units, we know we started out with 1,600 units. We sell 900 units. That means we have 700 units left over, and that corresponds to our units on hand in inventory. Now our accumulated cost is the $2,800 minus the 900 units times $1.75. So the amount now that amount subtracted from the 2,800 would equal the $1,225. Now we know what our accumulated cost is in inventory, and that's also would be represented in our general ledger. Now what we need to do then is take that $1,225, divide it by the $700, and we recompute our average cost per unit, but it recomputes as $1.75. So we have $1,225 worth of inventory value divided by the 700 units on hand, and that's going to come out to an average cost of still $1.75. Okay, now we're going to purchase some more units. So we're going to purchase, in this case, 400 units at $5 a unit. So the total transaction cost in this case would be $2,000. And if we do the calculation, basically we take 700 units plus the 400 units we just purchased. That means the number of units on hand would be $1,100. I'm sorry, 1,100 units. Now in terms of accumulated cost, we started out with, in the previous transaction, I'll write it up here, $1,225 worth of value in our inventory. But now we're adding to it that $2,000 worth of value from the current transaction. And so when I add our previous balance plus a new amount added to the inventory, it would be $3,225, which equals our accumulated cost. And also then you can see we have an average cost when we divide our 3,225 by the 1,100 units. Our average cost is $2.93, but that's irrelevant because we're being asked what is the value of the inventory at the end of the month, and that shows here the $3,225. Now we're going to talk about LIFO and FIFO inventory valuation characteristics. And whenever I say the word LIFO or FIFO, that typically strikes fear in the hearts of the CPA candidate. It's really not that bad if we kind of analyze what's going on. Now, typically when we're buying inventory at various prices depending upon what the market dictates between a willing buyer and a willing seller. Now, that creates a problem when we're dealing with FIFO or LIFO, because the question is, if we buy something at one price, that's what its price is in inventory, then we buy something else and then it's purchased at another price, then we sell some of that inventory. At what cost do we release out of that inventory? Let's use an example here. Let's assume that we buy 100 units, and I'll put 100 there, and we buy them at basically, let's say, $20 a unit. And I'll try to use a dollar sign here. So overall, our inventory value would be $2,000, and I'll put that over here, the $2,000. Okay, the next time we buy something, let's say we're going to buy 50 units, and the 50 units are going to be, I'm going to make these prices a little bit larger so you can see the differentiation. Let's say I buy those 50 units at $30 per unit. So that means in my inventory, I'm going to add $1,500. Now, assuming right now we've made no sales, we're just talking about what we're doing here. So now we've taken basically four, or at least here, two distinct transactions, and we pay different prices for the inventory. And notice we're laying down what we call a cost layer. 100 units times $20 a unit gives me a cost layer of $2,000. Then I purchase another group of those units, and it's 50 units times $30 per unit, and I've laid down another cost layer there equal to $1,500. Now let's assume I buy another, let's say 30 units, and in this case, so the price has gone up to $40. So in this case, when I take the 30 units times the $40, that means my total cost is going to be $1,200. And let's assume now we're going to buy another 100 units, and in this case the cost will go now to $50. So that's $5,000 in total cost. Now, if we were to add up each of these transactions, it would be a credit to accounts payable, debit to inventory of these dollar amounts over here on the right. So at this point in time, if I added up my entire inventory amount, it would add up to $3,500, $4,700, okay, $9,700, I believe, if I do my calculations right. That's adding cost layer 1, 2, 3, and 4. I'm going to say $9,700. If my addition is wrong, just humor me. Okay, so that would be the amount that's in my general ledger account, but it's not composed of one. Since we're not doing moving average or anything else. We're doing with what we call FIFO or LIFO costing. What we have is we have 4 distinct layers with different costs within that, representing our total inventory amount. Now, what happens is in our inventory costing is when we sell stuff. Okay, and think of these, you can think of these simply as cost layers, or you can think of them as like layers on a cake or whatever. Each layer represents a different amount of units at a different value per unit and a total value. So the cost layers are created in chronological order based upon their purchases. So the $2,000 cost layer was the first group of purchases, and $1,500 is the second, and so forth. Now, when inventory is sold, the inventory is liquidated, and that's liquidated into cost of goods sold based upon a FIFO, first in or first out, or LIFO, last in first out, cost flow assumption. Now, no matter what you've seen to this date, whether it's FIFO or LIFO, it's exactly the same way we lay down cost layers. So what LIFO or FIFO really means is, under FIFO, basically, it's a direction layers are liquidated under FIFO. So let's do an example of that for FIFO. Let's assume now that these 4 cost layers exist, and I'm now going to sell 90 units of 90 units themselves. So it's pretty easy because under FIFO, I liquidate the first in, first out. In other words, the first layer that came in is the first layer that goes out. So if I sell 90 units, it's going to be 90 units times my cost per unit, which will be $20 a unit. That's a $sign at the top. And that's what that means is $1,800 worth of costs. So $1,800 of costs are going to be liquidated from inventory. In other words, credit inventory, and the debit will go to cost of goods sold for $1,800. Okay, let's do another transaction. And in this case, a transaction, let's assume that we sold let's assume that we sold 50 items. So again, we have our 50 units. But now the question becomes, how do we calculate this? Well, if we take a look at this, we know we originally had 100 units in our cost layer, but we sold 90 of those units. So that means we still have left, and I'm going to do this cross out right here, we still have left we still have left now remaining in our cost layer 10 units at $20 per unit. So what happens is, with these 50 units, I can't cost them all at 50. So what I'm going to do is, I can't cost them at $20 a unit. So I basically I liquidate my layers. So I take 10 units from my cost layer 1, because that's all that's remaining, and I multiply that times the $20 per unit in my cost layer. So I'm going to liquidate the remaining amount of my cost layer 1, my first cost layer, in the amount of $200. So that's part of my transaction, but I still have 40 more units to account for because I sold 50 units. So now I need to liquidate the next 40 units from cost layer number 2. So in this case, I'm going to liquidate 40 units times my cost layer 2, which happens to be $30 a unit. So in this case, I'm going to liquidate 40 units at $30 a unit, and that is going to equal $1,200. So the total cost of my transaction in this case is equal to $1,400, which represents the remaining costs from layer 1 and the 40 units of cost from layer 2 that I've used up. And I keep on doing this process throughout all the cost layers. So that's how we do it on a FIFO basis. Now, let's go ahead, and what I'm going to do is I'm going to reset this slide so we can do this on a on a LIFO basis. I said I'd reset this slide for you, but however, due to the limitations of technology, and probably in my case, the limitations of my ability to use technology, when I tried to reset the slide, unfortunately, it reset all the little scribblings in here that I needed, in addition to eliminating the items I didn't want. So what I'm going to do is I'm going to make up for that lack of my ability to control technology. I'm going to switch to a different ink, which will give you a little bit of the distinction between FIFO and LIFO. Okay, now we talked about the basically that under FIFO, layers are liquidated on a first in, first out basis. Now let's take a look at what happens if we use LIFO. Okay, again, let's go back with the first line assumption. We start out with the fact that we sold, and again, everything, all the costs are laid down in exactly the same way in LIFO as if it were FIFO. But now the difference is in how we liquidate the layers. So in the case under LIFO, we're going to assume that we sell 90 units. So I'm going to put down 90 units, the 90. But in this case, the cost is not liquidated from the first layer. It's liquidated under the last in, first out. So it'll be liquidated from the last layer. So I take 90 units from my 100 unit cost layer and I multiply that times the unit cost of $50. And in that case, the unit costs are going to come out to $4,500 in this particular case. Now notice if we try to look at the two transactions, I'll draw a little dot across here. If we recorded the sale under FIFO, the cost of goods sold would have been $1,800. If we recorded under LIFO with these extreme price changes, the cost of goods sold for that same sale would have been $4,500. Now we're going to assume a sale of 50 more units. So in this case now, we know we only have 10 units left from cost layer 4 because we sold the first 90 units. So we're going to do 10 units, and again, this will be from cost layer 4, which is $50 a unit. And that is going to be $500. Okay, so now we've liquidated all of cost layer 4. Now we sold, as I said though, we sold 50 units. So we've used 10 units from cost layer 4. Now we have to start going to cost layer 3. And in this case, we have 30 units from cost layer 3. So it'll be 30 units times $40. That's a 4. A poor 4, but a 4. And that means the total liquidation in that layer is going to be $1,200. But you'll notice we're still not up to 50 units yet. We still need another 10 units. So, and we've liquidated cost layer 4 and 3. So now we move up to cost layer 2. And in this case, we liquidate 10 units from cost layer number 2 at $30 a unit, and that's going to become $300. So what you can see is we liquidate all the units at their individual costs in the individual cost layers. Now, notice this here also, under FIFO, assuming that this occurred during, or under FIFO, assuming that these transactions occurred during the year, the total amount of cost of sales would be the 1,800 plus the 1,400. That means my total cost of sales under FIFO would be $3,200. Under LIFO, it's going to be considerably different. What you can see basically is that it's going to amount, in this case, to $6,500 in terms of cost of goods sold, if my addition is correct again. And so what you see is under FIFO, with inventory prices in this case rising, I have a cost of $3,200. In the case of LIFO, since I'm going with the last cost first in a period of rising prices, my cost of sales are considerably higher, $6,500. So that gives you a little bit of insight into LIFO versus FIFO characteristics. Okay, now we're going to calculate we're going to use a perpetual inventory, but we're going to use it based upon a LIFO inventory basis. So we're going to assume right now our beginning balances, and our beginning balance in this case, we have 60 units on hand. They're from what I'm going to call a layer 0. In other words, just a neutral layer, and the beginning balance is basically the cost is $20 per unit times 60 units. So the total value of our inventory is equal to $1,200. Okay, now we're going to get into how the transactions impact our balances. Okay, this is the beginning transaction for our LIFO perpetual inventory. You'll notice in this case that we went and purchased 20 units of inventory. And if we take a look at the cost of our transaction, it was a purchase of 20 units of inventory. We spent $32 per unit. This establishes what we call our layer 1 cost of $640. If we remember our units on hand, we begin with our 60 units. We purchased 20 more units, so the number of units on hand in inventory is 80 units. So now under LIFO inventory, we have to determine what is the cost, and that means determining the cost of each layer. So layer 0, basically the beginning balance, layer 0, the cost per unit in layer 0 was $20 a unit, and we had 60 units. That means the total value locked within layer 0 is $1,200. Then we go to layer 1. Layer 1 is our first purchase of the 20 units. And in this case, we spent $32 cost per unit times the 20 units that establish now layer 1. And that value of layer 1 now is $640. So if we combine these two layers together, the 1,200 plus the 640, that means the total value of our inventory balance is $1,840. Now we're going to go on to transaction number 2. Transaction number 2, or date number 2, if you will, shows that we sold inventory, and we sold 70 items. Now in this case, again, when we take a look at our units on hand, we started out with 80 from the previous transaction. We sold 70, and now we have 10 items left. The question is now is that we're working on a LIFO inventory basis in a perpetual inventory, and how do we value this transaction? Because the cost of the transaction could come from one layer or another, or a combination of the layers. Well, we're using the LIFO rules in this case. So what we do is the last layer in is the first layer out in terms of costing. So what we need to do is look at the last layer in, which happens to be layer number 1. And we know we sold 70 units. So in order to cost the items properly under LIFO, we have to basically take the first units out of our latest layer in, which is layer 1. Our layer 1 has a cost of $32 per unit, but you'll remember we only have 20 units in layer 1. So we take the 20 units in layer 1 and we subtract out 20 units from layer 1. And in that case then, we see in layer 1, we take our 20 units times the $32 cost. That means we subtract out $640 out of inventory into cost of goods sold for our for layer 1. But now we're not done with liquidating the layers because we've only liquidated 20 out of the sale of 70. So now we've got to take the next 50 units from the next latest layer. In this case, that is layer 0. So we take 50 units from layer 0. We multiply it times our layer cost per unit, which is $20 a unit, and that is going to come out to $1,700. So when we make the journal entry for this particular sale for cost of sales, it's going to be a combination of these two layers in terms of cost. It'll be a credit in the total of $1,640 to inventory and a debit to cost of sales of $1,640. Now we can look at the amount of value left in our ending inventory according to our layers. So we take a look at layer 1, and what we see basically is that we had 20 units in layer 1. We used up the 20 units, so the remaining value left in layer 1 is equal to $0. Layer 0, on the other hand, we can see we had 60 units originally. We used up 50 of those units, so there's 10 units. In effect, there's 10 units left times $20 per unit, and that equals $200. So the combination of these two layers in the end equals to be $200. And you can see the details of the transactions. Let me switch to another color here for a second. Okay, so we started out with the $1,840 inventory balance from our previous balance. Okay, we had to subtract out layer 1, which are the 20 units times $32 a unit. So we subtract out $640. We also have to subtract out 50 units from layer 0, which amounts to $1,000. So we subtract out the $1,000, and you can see we get back to the $200. Okay, let's go on to the next transaction. Okay, in transaction 3 now, we are purchasing additional units, and in this case, we're buying 30 additional inventory items. We're buying 30 units. We're paying $14 a unit. Now this becomes layer 2 cost. And you ask, well, what about layer 1? Well, it's gone, so we don't even pay attention to it. It's basically layer 1 exists, but we have zero units, 0 value. So now we go to layer 2. So the layer 2 cost is basically is valued at $420, which is our 30 units times $14 a unit. And if we go back and take our look at our units on hand, we have 10. We originally had 10 units on hand. We purchased an additional 30 units, so that means we have 40 units on hand. So in theory, if we went out to our inventory warehouse, we should be able to account for 40 units that are sitting in the warehouse. Now we can look at and see how our inventory layers are composed, and we see we have layer 0. It still remains because it still has 10 units remaining. So $20 per unit times 10 units remaining means that there's $200 of value in layer 0. We also now have layer 2 that we've added, and in that case the cost per unit is $14 times the 30 units we purchased, which is $420. So now to our inventory balance we can add that $420. So you take a look at the combination of the two and they add up to a total of $620. Now let's look at the last transaction where we're recording a sale. In this case, we are selling 20 units. Okay, so we're going to sell our units and we're going to liquidate our layers based upon the last layer in is the first layer out. So we're going to start our liquidation utilizing layer 2. And in layer 2, we have 30 units at $14 a unit, but our sales only for 20 units. So we only have to partially liquidate layer 2. So we're going to use the 20 units from layer 2 times that $14 from our layer 2 cost. So the cost associated with this transaction is $200. So the entry would be credit to inventory and a debit to cost of goods sold for $280. If we want to update our units on hand, that's 40 from the previous calculation minus the 20 units we just sold, and that leaves us 20 units in our inventory balance. Now again, if we want to calculate the value of our total inventory by layers, it should be equal to layer 0, which still has 10 units remaining in it at $20 a unit, so that's equal to $200. Also, we have layer 2, where we had 30 units and we just used up 20 units as a result of this sale. So now we basically have 10 units left in layer 2 at $14 a unit. That means $140. So you can see basically our layers are based upon the the $200 layer 0 and $140 layer 2. So the total amount then is the value of our inventory is $340. Of course, we cannot leave LIFO without at least one multiple choice question on calculating perpetual inventory under LIFO valuation. So here we're given the following information. It pertains to the inventory noted on a company's perpetual inventory items, and we're given our units, the unit cost, total cost, units in hand. Some of this is useful, some of it isn't. Then we have our beginning balance, our transactions, and what it asks you to do is under the LIFO method, what is the amount of inventory that should be reported at the end of the month. So we know it's a perpetual inventory system and it needs to be valued under the LIFO method. So again, do your own calculations off of this particular slide. Stop the video, and when you are ready, when you've selected the correct answer, go ahead and restart your video. Okay, let's take a look at the answer to question number 13. Again, under the LIFO method, what is the amount of inventory that should be reported at the end of the month? And again, we're told it's a perpetual inventory system. In this case, the correct answer would be answer B, $2,700. And I'm going to go through the transaction to see how I arrived at that calculation. Okay, the first thing is we start off with our beginning inventory, and we know basically it's 1,000 units, $1 per unit. So basically we know the value of our inventory in beginning inventory is 1,000, basically is 1,000. Okay, now we go on to our purchases for day 5, and we're purchasing 600 units at $3 a unit. So here I show on my my calculation, we have 600 units at $3 a unit. So the total transaction cost, which is the same in the schedule above, is $1,800, and I'm going to also track the accumulated units, which is simply my 1,000 units I had purchased originally plus the additional 600 units. That equals the 1,600 units. Now I want to see what my inventory is composed of. So I start off with my beginning layer of inventory, which is 1,000 units times $1 a unit, and it gives me a beginning inventory layer balance for that this layer of 1,000. Now also at the end of day 5, after my purchase, I have to add another cost layer to my inventory, and that is I call it the day 5 layer. And it's going to be, again, 600 units times $3 per unit, which means my cost layer for day 5 is going to be $1,800. So now I have 2 layers of inventory, and those 2 layers of inventory add up to $2,800, and that would be the amount that's in my general ledger. Now I get to my next transaction, which would be sales of 900 units, and of course if I sell 900 units, given that I have 16 units on hand, I'd have 700 units left over. Now let's see how I go about valuing those units. So the first thing is that I take, the first thing is, since I'm doing LIFO, my last cost out, in other words, my most recent costs that came in are the ones that go out first. So I look at my last layer, which would be in this case layer 5. Layer 5 has 600 units in its layer at $3 a unit. So I'm going to, in effect, liquidate the entire layer 5 because I need those 600 units to cover my sales. So it's 600 units times my $3 in day 5. That means the total cost layer for those day 5 units is $1,800. However, I sold 900 units and I'm only able to liquidate 600 units from my day 5 layer. That means I need to go into the next most recent layer, which is my beginning inventory layer, and I pull out 300 more units. So I'm going to have 600 units and 300. That's going to equal my total sale in this case of 900. That should be a number of 900 there. So I'm going to take 300 for my beginning layer times its original cost of $1 per unit, and the layer that I'm going to liquidate, the value there is $300. It's 300 units times $1 per unit. So if I add up my total cost of $1,800 and 300, my total transaction cost, the amount of value that I'm taking out of inventory, is $2,100, and moving that to cost of goods sold is $2,100. Now if I want to value my inventory again, it's fairly simple. I start off with my beginning inventory layer, which now has 700 units left over instead of 1,000 because I had to use 300 of those units to cover the remainder of my 900 units. So now I have 700 units times $1 each. So the value in my beginning inventory layer is $700. I can take a look at my day 5 layer now, and actually my day 5 layer is no longer relevant since I used every unit. I basically liquidated every unit in costing the day 5 layer. So I have no units left times $3 a unit equals basically 0. So layer 5 is no longer relevant. So the total value of my inventory at LIFO at this point in time now is $700. Now I go into the last point where I purchased on day 28 400 units at $5 a unit. So here's my purchase of 400 units at $5 a unit, and my total transaction cost is $2,000. The accumulated number of units is my 700 plus the additional 400 units I just purchased, so that ends up being 1,100. And what I need to do now is I need to recalculate my inventory at LIFO. So now I create a day 28 cost layer, which shows 400 units, and the cost is $5 per unit. So the total cost of my day 28 layer is $2,000. My beginning inventory layer still remains the same since I didn't have to liquidate anything. So it's going to be 700 units times $1 each equals $700. So my total cost is equal to the $2,700, which corresponds to our answer B, $2,700. Now we're going to do a demonstration of perpetual inventory utilizing FIFO evaluation. And this involves all the exact same inventory transactions we have just gone through. So it's the same inventory transactions, but the difference is we're valuing it on FIFO as opposed to LIFO. So to begin the process, we start out with the fact we have beginning balance of 60 units on hand. We're going to call this layer 0, and the cost per unit in layer 0 is $20 times our 60 units. That means our inventory value is equal to $1,200. So that's our background information. Now let's combine that background information with our first transaction where we had a purchase. We had purchased, just like in our LIFO demonstration on date number 1, we purchased 20 items. So we take our 20 units that we had purchased times our $32 cost. That was our purchase price. That means we have created now a layer 1 cost of $640. And if we go back and look at our units on hand, our beginning balance was 60 plus the 20 additional units. That means our ending balance is 80 units. Now we can take a look at how we comprise these cost layers in terms of our inventory balance. We start out with layer 0. If you remember, it was $20 per unit times 60 units. So our total cost is $1,200 in layer 0. Now we've added layer number 1. And in this case, we've taken basically layer number 1, the cost per unit is $32 times the 20 units, and that equals $640. So now we have our beginning layer, layer 0, plus our unit cost of layer 1 cost is $640. So our total value now in inventory is $1,840. Okay, in this particular transaction, we had a sale where we sold 70 units. Now, the way we have to cost this, it becomes a little bit more complex because now we have to deal with layers. Okay, the first thing we have to understand is that we liquidate our cost layers in the newest cost layer, in other words, layer 1, and then if we have to, we'll go back to layer 0. So in this case, we take a look at this and we basically have, okay, with transaction number 3 now, we are buying another 30 units. And in this case, we're buying those 30 units at $14 a unit. So 30 units times $14 a unit means we're going to add a cost layer, layer number 2 of $420. And again, if we go back to our units on hand, 10 units on hand plus the additional 30 that we're buying, so we have 40 units in our perpetual inventory. And now I can basically construct the inventory dollar balance based upon our layers. In layer 1, we have 10 units remaining, which means $32 cost per unit times 10 units remaining means that layer 1 has a value remaining of $320. Layer number 2 has a cost now of $14 per unit, and we're purchased those 30 units. So $14 a unit times the 30 units equals $420, or the combination, if you will, of these two layers equals $740, and that's the value of our FIFO perpetual inventory after date number 3. Okay, let's take a look now at date number 4. And of course, in this case, we sell 20 units. So in this case, we have to, in order to calculate the reduction of our inventory and our cost of sales, we have to determine what layers we're going to cost this sale out of. Okay, the first thing we know is, again, we're dealing with a FIFO basis calculation, which means the first layers are liquidated first. So right now we have a layer 1 and a layer 2. So we're going to liquidate layer 1 first. Now we know we have 10 units left in layer 1. So what we're going to do is we're going to liquidate those remaining 10 units times the cost per unit in layer 1, which is $32. So layer 1 cost will be liquidated at $320. Okay, now we take a look at, now we've used up all of layer 1. Now we take a look at layer 2 because that's the next first in layer. And in this case, we have 30 units that exist in layer 2. Now, in this total item here, we needed to have 10 units from layer 1, which means we need to have another 10 units subtracted from the next layer, which would be layer 2, in order to equal our entire 20 unit sale. So we take 10 units now from layer 2, and it'll be the 10 units times the cost of $14 a unit, layer 2 cost. That ends up being $140. So if we add these two values together, what's going to happen is we're going to have a credit entry to inventory of $460, and the debit would go to cost of sales for $460. As far as perpetual inventory records go in terms of units, we start out with our 40 from our previous units on hand. We sell those 20 units, and we're going to have 20 units left within our perpetual inventory. And if we take a look at our calculations here, we see layer number 1 in terms of building the value in inventory. We had 10 units to start out with. We liquidated those 10 units in our sale. So the value of the remaining layer 1 inventory is equal to 0. So we don't even use that. Okay, in layer number 2 then, we had originally 30 units, and we subtracted out 10 units from the sale. So that means we're going to have 20 units remaining. So $14 cost per unit in layer 2 times $20, that equals $280. So if we combine these two together, we start out with a $740 inventory balance. We subtract out, let me change my color here just so it's a little less confusing. Then we subtract out our layer 1 cost of $320. That pound sign shouldn't be there. And then we subtract out our cost in layer 2 of $140. And those two items basically subtracted from the $740 original come out to $280, which happens to be, if we combine these two layer valuations together, that's the $280. Some other important characteristics between LIFO versus FIFO, or if you will, FIFO versus LIFO. Okay, and again, sometimes these questions are asked in the exam, especially in the multiple choice questions. Let's take a look at FIFO first. Under FIFO, ending inventory and cost of goods sold estimate the current replacement cost of the inventory. So what you're really saying is that the ending inventory and the cost of goods sold represent the most, in effect, the most current inventory cost because of the way you're costing under FIFO. Now with FIFO, in a period of rising prices, okay, FIFO will produce a lower cost of goods sold and a higher ending inventory than LIFO. So in a period of rising prices, basically under FIFO, it'll produce lower cost of goods sold and a higher ending inventory over LIFO. Now this is why FIFO is not as popular in inventory valuation is LIFO. And the reason for that is that a business basically in a period of rising prices, which basically our economy is based upon some element of inflation, basically we want to be able to produce in effect the highest cost of goods sold because that reduces our tax bill. And there are some archaic tax laws that require that if you use LIFO for inventory, for tax purposes for inventory, you must also use it for your financial reporting purposes. So that's the reason that LIFO is more, basically what we just said regarding FIFO, that's the reason that LIFO is more, is used more often than FIFO is. It's basically a tax issue. Now, in the case of LIFO, last minute purchases of inventory can impact income because those are the purchases that are going to be used first in determining basically your cost of goods sold and then eventually net income. And this is basically the same box as FIFO, but in a period of rising prices, LIFO will produce a higher cost of goods sold and a lower ending inventory over FIFO. So again, the reason most businesses want to use LIFO is they will produce a lower cost of goods sold, which means you're going to have a lower net taxable income. And most businesses want to minimize their taxable income. And as I mentioned, under certain tax rules, if you use LIFO for tax purposes, you have to use it for your financial reporting purposes. Now this is a multiple choice question that you can get on the CPA exam. Again, pretty much what we just went over regarding the different characteristics of FIFO and LIFO. Generally, which inventory costing method is most approximates the current cost of each of the following? And again, you're given 4 choices. Go ahead, stop the video, examine your choices. When you arrive at what you believe is the correct answer, go ahead and restart your video. Okay, and the answer in this case, generally which costing method most approximates the current cost for each of the following? And in this case, the answer would be A, cost of goods sold for LIFO, under current cost for LIFO, and ending inventory, it would be FIFO. Now, the LIFO basis assumes the most recently purchased items are the first items to be sold, at least from a costing perspective. Therefore, LIFO is normally the best approximation of your current cost of goods sold. The FIFO basis more closely approximates the current cost of ending inventory because it assumes the most recent purchases are the last that are going to be sold. Now we're going to be covering probably the most feared area in inventory accounting for aspiring, again, accounting CPA candidates, and it's called dollar value LIFO. And I'm sure you encountered it in either your intermediate accounting class or some advanced accounting class, and it was pretty hard to figure out. And if you kind of know it already and you've already figured it out, good for you. That's awesome. But for most students, it kind of remains a mystery. Now, I'm going to approach this in this particular presentation at the 50,000 foot level, just from a conceptual standpoint. But I'm not leaving you hanging high and dry. What's going to happen is I'm also publishing a very, very detailed video on how to perform dollar value LIFO. So in addition to this, in effect, 50,000 very quick view with a couple multiple choice questions, I'm going to present you with a how to do video of dollar value LIFO that will take it down to, it'll take it from the 50,000 foot level down to ground level. So at this point in time, again, just kind of enjoy this 50,000 foot ride and try to answer the questions. And if you want the details, go to that additional video that's in the classroom. Here we're going to talk about dollar value LIFO. And in dollar value LIFO, the reason it's probably one of the most popular inventory valuations that is used, and that's because overall it's a lot easier to use, especially now that we have computers that can pretty much do all the number crunching that is necessary. But in dollar value LIFO, the cool thing is we don't need physical units to calculate our ending inventory. We can actually do it through what we call dollar value LIFO cost pools. Now, because of this, inventory is viewed as a quantity of value instead of physical quantities of goods. And the other cool thing is we're able to create massive, or I should say large, inventory pools by combining a large variety of individual inventory items into this one massive pool. Because in basically what happens is that each item has a value, and the common, if you will, denominator for each item is value. So physical units are not used in calculating the ending inventory. So again, instead of layers of units from different purchases, we basically use a dollar value inventory pool, basically comprising of layers of dollar value from different years. Now, the one thing that's a problem with dollar value LIFO is that, as you probably already know, the U.S. economy and most economies are based upon a moderate amount of inflation. And if you want to know about that, go and talk to an economist, because there is a reason that inflation, again, a moderate amount of inflation or a small amount of inflation actually is good. But one of the problems with that is that when we're trying to compare changes in dollar values of cost pools from year to year, they're not necessarily the same, because we're literally comparing apples and oranges. So we need to come up with some type of constant value so we can compare apples with apples. Obviously, if we want to compare inventory costs that were created in 1964 against inventory costs that were created in 2017, it's pretty intuitively obvious that it would not be easily measurable in terms of true change, simply because of the concept, for the most part, of inflation. So what we need to do is we need to compare these changes in our inventory dollar levels or layers in terms of constant purchasing power. So we have to go through a price indice or price index calculation. So we want to value our ending inventory cost pools as if they were costed at a base year, and for each year after that at the base year. Now, what base year do we pick? Well, we just pick one. We got to pick it. And what we're going to do then is we're going to convert our total current year-end cost using an index, basically convert the current inventory values to base year values. And what you can see here is that, as an example, in year one, what will happen is that our total year-end cost is converted to as if it were our base year cost. And again, what we do is we take all those items in inventory and revalue them at a base year cost. And that sounds hard, but not with computers nowadays. That can be done. In effect, the same basket of items in the pool should be compared to a similar basket, a price basket back at the original base year cost. In this case, we have a demonstration here where we're doing this for year 1, 3, and, or sorry, that should be 1, 2, and 3. And we see when we convert it, we see here we have our total value at base year cost. Here's 50,000, then 40,000, then 50,000 in year 3. And interestingly enough, of course, I force this to be this way, but you'll notice every year we show an increase in our cost, our year-end cost in current year terms. But if we take a look at, if we value it at our base year cost, actually we see our inventory value went down from year 1 to year 2. And then it went up slightly went up in year 3, back to what it originally was. But that, when that's at our base year costs, and it doesn't look that way when we use our current year costs. So that's one of the reasons we need to do this. We need to do these calculations, and we're going to basically create what we call chained indices from these. Like in year 1, we take our total current year cost of $60,000. And we're going to divide it by our base year cost, which will be $50,000. And the price indice in this case will be overall 1.2. In year 2, then we chain these together. It'd be $70,000 cost, $70,000 cost. So we have a $60,000 cost in year 1, a $70,000 cost in year 2. Now we're going to divide that by our original cost of $50,000 in year 1 and $40,000 in year 2. And in this case, we come up with an indice of 1.4. We're going to chain that then with year number 3, and we have our basically our $60,000 cost from year 1, $70,000 current year cost from year 2, and $80,000 from year 3. And that's going to be divided by the total, our base amounts of 50,000, 40,000, and 50,000, and we end up with the basis of an indice of 1.5. So these indices are a way of basically shrinking back the different levels of current year costs to base year costs. So with that, that's as far as I'm going to go in explaining dollar value LIFO. If you want to go over the dirty details, go ahead and review that separate video. Okay, let's start off with question number 15. Estimates of price level changes for inventories are required for what type of inventory valuation? This one should be pretty easy for you. So again, stop the video, make your selection. When you're ready, restart your video. And the answer to this particular slide should be no surprise to you. It is B, dollar value LIFO. Okay, here's a multiple choice question regarding, again, related to dollar value LIFO. This company adopted a dollar value LIFO inventory method as of January 1st, year 4. A single inventory and an internally computed price index are used to compute Dial's, the company's LIFO inventory layers. And the information regarding the dollar value inventory layers are as follows. And we have our base year, year 1 layer, and year 2 layer. And we have the amounts at their base cost and also their current cost. So what was the price index used to compute Dial's year 2 dollar value LIFO inventory layer? And this is an excellent question of what you could be asked for dollar. People are afraid they're going to have to go through an entire dollar value computation, but it can be something as simple as this. Okay, go ahead and basically stop the video, do your calculation if necessary, and select your answer, and then restart your video. And the solution to this problem, which is C, 1.33, is actually, when you look at it, it's simpler than you may have anticipated. If we take a look, and I've computed the indices from all the years. If we look at basically our year, we have the base year, the layer year here, and the total the base year cost is basically in the indices 1. It's our $90,000 over our current cost of $90,000 over our base cost of $90,000. Now we go to the year one layer, and in this case, again, we chain it. We take the $90,000 base year divided by the $90,000, but now we have to add our year one layer. Our current cost is $30,000, and that part is divided by, that's part of the quantity, it's divided by $20,000. So in this case, it comes up to, year number one comes up to 2.10. Now we go on to year number two, and again, we include our previous year's calculations, 90,000, which will be divided by 90,000, the entire quantity, 30,000 divided by our 20,000, and then the last item, our current cost is $80,000, and that is going to be divided by $40,000, or the quantity of all those items there. So year number two comes out to the 1.33. Okay, now we're going to spend a few minutes and talk about lower cost of market. It's not that difficult, but it does have a bunch of rules that you kind of have to memorize. There's kind of no way of getting around it. But in accounting, inventory is valued at what we call the lower of its cost or the market value. Now, those definitions may not necessarily mean exactly what you would think they'd mean. So let's talk about them. Or matter of fact, before we talk about calculating lower cost of market, let's look at some of the rules regarding lower cost of market. Let's assume an adjustment has to be made for LCM, lower cost of market. Okay, if we make the adjustment, it's recognized as a loss in the period that it was realized. Okay, now the loss is usually put into cost of goods sold, but if it is a material loss, it should be reported separately or separately disclosed. Something else that is important, once it's written down, it cannot be written up in subsequent periods. Now, when you're calculating lower cost of market, the LCM may be applied to individual inventory items or the inventory as a whole. LCM doesn't have to be applied at interim financial statement date if it's anticipated legitimately that there will be no permanent loss for the year. However, the loss associated from what you'd be considered a non-temporary decline must be recognized at the interim financial date. So those are some of the rules that you have to remember regarding lower cost of market, even before you know how to calculate lower cost of market. And the theory is the inventory must be written down to what we call market. And again, market may be a little bit different than you're used to. I mean, it must be written down to market subsequent to the realization that its utility, in other words, its probable future economic benefits, is less than its cost. Because what they're saying is, well, if you can't get your money out of the inventory, it's not worth what the value you placed upon it. And that goes back to the old accounting postulates of the principles of conservatism. Now, market, here's where it gets a little hinky. Market is the current cost to replace the inventory. Okay, within a ceiling and a floor. Market cannot exceed net realizable value. What that means is the current cost less additional processing or other costs associated with selling or disposing of the inventory item or items. The market cannot be below net realizable value less an allowance for a normal profit margin. Okay, and again, this is you've probably learned this in your intermediate accounting course, but it's a good review. Okay, let's try one multiple choice question regarding lower cost of market. Which of the following statements are correct when a company applying the lower cost of market method reports its inventory at replacement costs? So you're given several different choices. Go ahead and stop your video, ponder this for a few minutes, and when you're ready, make your choice and restart your video. Okay, let's take a look at the answer in this case, and the answer is B, 2 only. In other words, the net realizable value is greater than the replacement cost. Okay, in this case, remember that the market is equal to the current replacement cost subject to a ceiling, and the minimum is the net realizable value less a normal profit. So hence the only item that could apply would be item number 2. The net realizable value is greater than the replacement cost.